Very good evening to all of you students. Today we will continue with the sessions, and today's topic would be on dividend decisions. Hitesh, good evening. Mancha. So before we get into the dividend decisions, I think there are a couple of queries from Mancha. Let me take up that. Those are on risk analysis and capital budgeting. So Mancha is asking, can fixed cost be treated as input variable in sensitivity analysis? And the answer is yes, because fixed cost is also a kind of input only into the capital budgeting model that we discussed, right? So that can be very well treated as one of the input for the sensitivity analysis. And how? For example, the question can tell you if the fixed cost is increased by 10%, then you compute the impact on NPV. Or let's say the fixed cost is reduced by 10%, then you compute the impact on NPV. So this is a very well, practical thing. So Mancha, answer to that question is yes. Then second question is, we consider estimated cash flows while computing profitability index technique. Can this technique be applied with expected cash flows also? Okay, so Mancha, so what we discussed in our previous session is, what is the difference between estimated cash flows and expected cash flows? I think you're trying to ask this question, right? So estimated cash flows are the different scenarios with different probabilities that we discussed, right? And expected is the average of them. Correct? So using estimated only, you will arrive at expected. So here, let's say 2000 cash flow, it has a 10% probability. 5000 cash flow, it has a 20% probability. Then 10,000 cash flow, it has a 70% probability. So this is how 100% probability it is. And the average of this will give you the expected cash flow. That's the use of the entire probability index. Okay. Shreya, good evening. Banredi, good evening. Kaveri, good evening. Mancha. Okay, there is another question. In one question of study material question, we have asked to calculate risk premium. Beta is equal to covariance by variance. Is this correct? Okay, so this, Mancha, I would say that this query, you keep it on hold until we go and discuss the CAPM, capital asset pricing model. Although beta is equal to covariance by variance seems okay, but we will cover that part in detail there, along with the logics and whys. Janesha, good evening. Rahul, good evening. Khushi, good evening. Siddharth, Noor Ahmed, Sneha, Rahul Soni, Bharadwaj, Siddhante Lee, Pooja. All of you, good evening. And now let's start with our today's topic on dividend decisions. So students, again, I would request all of you to please, listen very carefully. Please actively participate. Ask as many questions as, it comes into your mind. Okay. So first of all, if I can classify some types of the decisions that a corporate usually takes, what would those be? First of all, we can say that apart from the regular operating decisions, right? Because see, operating decisions are part and parcel of the company. They are taken on a daily basis to run the company, right? So apart from those operating decisions, what are the other kind of decisions? One is the financing decisions. Second one is investing decisions. And third one is actually dividend decision. Okay, students? Perfect. Hitesh is saying financing, investment, and dividend. Right, Hitesh. Perfect. See, the financing decisions are concerned with what type of instrument you would be issuing to get the funds. Whether it will be equity, whether it will be bond, whether it will be debenture, whether it will be preference share, whether it will be some kind of a convertible preference share, or how are you going to do the finance, right? Finance means how are you going to do the funding. Investing decisions, on the other hand, are related to the investment in a particular proposal. So the entire capital budgeting is helping you to evaluate an investing decision, whether to invest or not in a particular project. Correct? Now, this is what we are going to discuss today, which is the dividend decision. I think these both of them you would have covered in some of your earlier sessions somehow, both investing and financing decision, right? So today's session would be on dividend decision. And this is very, very interesting topic, I can tell you. Okay, so just understand on the logics and, let's try to build our concept. So I am taking this dividend decision into detail now. Okay, let me start with the balance sheet of a company. I'm making it in T form. Okay, now anyhow T form is not applicable, but just for the understanding. So there is this share capital. This is equity and liability side. Okay, so there is some amount. Reserves and surplus, there is some amount. Then you have other liabilities. Let's say I'm putting creditors and other current liabilities, let's say. Okay. Similarly, you have assets. So let's say you have fixed asset, which is property, plant and equipment. Then you have investments, some kind of investments, right? So investments are basically coming. So these are coming as a result of your investing decisions, right? And if there is any other instrument issued, comes under financing decision. Now, and finally, you have cash and cash equivalents also, the hard cash that you have in the form of bank accounts or in the form of hard cash or in some kind of liquid investments. Okay. Now, as a board of director, right, you are in a dilemma whether you have the surplus cash with you because the last year has been a good amount of profit. Whatever you expected, you earned out of it, the company. So you are in a dilemma whether to give any kind of a dividend or not, right? Because there are two options with you for this cash and cash equivalent, or there can be in any other form as well. But I'm taking cash and cash equivalent. Either whatever you have earned, you can retain them or you can pay them, right? So I'm talking about, let's say, the profits of a company. So the profits, either you can retain them or you can pay them. If you pay them, they will be called as dividend. Correct. And dividend can take two forms. Even dividend can also be settled in two forms. One is which involves a cash outflow, and one in the form of bonus shares. Okay. So bonus shares does not involve the cash outflow, neither a cash inflow. And the first cash outflow can be in the form of warrant, right? ECS, check, or in any other form, the cash is going out of the balance sheet. Correct. That is how dividend is paid. Now, why this decision is very important? Because see, the biggest stakeholder, or I can say one of the stakeholder in the company is the shareholder. Correct. Now, shareholder expects some form of a return. Those returns are generally in the value of appreciation that a company is generally delivering in the form of, constantly the company's performances, the profits are increasing, right? So the value will also increase. And the other expectation is that the shareholder carries is that I should encash that value as well. Because until I sell my, equity share, I will not be able to encash it. So another form of encashing some part of my value increase is the dividend. So definitely investor expects some form of a dividend, right? But then there are different theories to it. So there are different guiding principles which will tell you whether payment of dividend is right or whether retaining the dividend is right. Because we need some kind of a guiding principle here, correct? And imagine one more situation. Let's say you are earning 100 crores per annum on an average basis, for last 5 years. Okay. And as a policy, you are declaring 80% of dividend out of this. Now, suddenly in one of the year, you get a very abnormal gain, very high gain. And hence your profit reported in that particular year is 500 crore for that particular year. Now, you will also feel whether you should continue with the policy of 80% on this higher amount also. because you know that definitely in the next year, again, the profit is again going back to 100% per annum, because there is some abnormal item sitting here. Abnormal item of gain 400 crore is there, which is not going to happen in future. Correct. So are you going to pay entire 80% on this, or are you going to hold back and pay dividend on an average basis? So this also is one of the problem statement in the dividend decision solving. So we will try to see how to navigate through this dilemma. I hope the problem is very clear, right? Because the problems with the companies is that, if I pay dividend, whether it will impact my share price. If I don't pay my dividend, whether again it will impact my share price. Whatever I am earning, it will also impact my share price. So what is that scenario in which my share price will be maximum? That is what, the thing is. So Mancha is saying dividend is dependent on the product life cycle. At maturity stage, companies pay dividend. Yes, Mancha, that's right. Because, for paying dividend, there are certain preconditions in our Companies Act as well, right? There has to be some kind of unreserved, so there should be free reserves, which are not earmarked for something, right? And there are certain conditions depending on which you can pay the dividend. If there are no profits, then how come startups can give dividend, right? So yes, to a certain extent, Mancha, what you're saying is right. So Danshu is saying no. I think he would be saying for this abnormal profits, whether they should give it or not. Pooja is also saying on average basis. So yeah, so it basically depends on the facts and circumstances of a particular case. Okay. And also what we are going to study now, that will also drive those decisions. Now, there is some sort of, I think first of all, it is clear that why we are studying this topic, right? Because it is a very big dilemma that the company faces, or it is a problem that the company has to solve. What sort of a dividend? Now, what is the significance of dividend decisions? So significance of dividend policy. So there are two significance that are given in our study material. One is the long-term financing decision. See, if you have a dividend policy in place, right, which is made out of those principles that we are going to discuss now, so it will help you. It will help you in taking your long-term financing decisions also. How? For example, you know that 5 years from now, there is an investment plan, or let's say today also there is an investment opportunity with us, right? There is an investment opportunity with the company, right? Now that kind of investment opportunity is offering us a return of 20%. There is a ROI that we can easily make on that investment opportunity, 20%. Okay, now there is a return that every shareholder expects, which is called as return on equity. This is called as KE. So the return that the equity shareholder expects, which is the return on equity, which is called as KE, is, let's say, only 18%. Because they say that, okay, in the market, for the similar type of companies which have similar betas, which have similar risk profiles, which have similar kind of business, generally market, we get 18%. So the same percentage we are also expecting from the company. And company have an investment opportunity to invest at 20%. So what do you think that company will do in terms of dividend? Whether company will pay the dividend? And I can also add one more fact here, that the company is carrying surplus cash because of the profits that has happened for the last couple of years, around, let's say, 100 crore. So the company is seeking that whether they should pay this 100 crore as dividend, or whether they should invest this amount back into the investment opportunity that the company is holding. If you have a dividend policy in place, then definitely you will be able to make the clear decision here, correct? And the decision is very clear. So the decision is what? if the investment happens, investor will get 20% appreciation. If I pay it now, right? If I pay it now, then I will lose this 20% income that is going to come to me in future. Correct. However, what is the expectation of a shareholder? The expectation is only 18%. So that means I will be able to deliver them more 2% beyond their expectation. So as a board of director, what I feel is that I should invest this amount in the investment opportunity rather than giving the amount as dividend, because that will be better for the company as well as for the shareholder. We will discuss these type of examples in detail, right? But as of now, I'm just trying to make you understand that this will also help you in deciding your long-term financing decision, right? So Karthik is saying company should retain. Ban Reddy is also saying investment. Hitesh is saying investment. Mansha, company should go ahead with the investment agent. Perfect. Noor Ahmed say how this chapter help us in professional life. So Noor Ahmed, this first of all, anything that you study will help you develop your thought process. Okay. Maybe the principles that are being taught, maybe I'm saying, right, 90% of the cases you will find in practical life, but 10% of the cases you will find that, these are not there in practical life. But I can definitely tell you it will develop your thought process. And that is very, very, very important for being a professional. Okay. Pooja is saying, as per Companies Act, dividend must be in cash and anything else in lieu of that. But here there are different types of dividend, cash, bonus shares, etc. So, okay. So Pooja will tell you, if you see the point that I was trying to say here is that, so bonus shares, actually, if you see, there is no incremental value that is given to the shareholder. Okay, you're right. So dividend is actually in form of a cash outflow only, right? But why we are saying that bonus share is also one kind of dividend is because, see, ultimately what happens after bonus shares, let's say you have 10 shares, correct? Now you get 10:1 share as bonus share. So, and your overall holding value was how much? Let's say 10 lakhs for these 10 shares, right? After even bonus share, your value of holding, or let's say the market value of these 11 shares will still be 10 lakh only, correct? Because bonus shares don't impact the market price, the market valuation. I'm saying price will go down per share, but the total value of the holding will remain same. But you now have an opportunity to sell this one extra share and get the cash. So this one extra share you can sell, correct? And still you will be holding 10 shares only. So through that message, we are trying to say that, there is some kind of breaking down of the valuation here for per unit basis, and hence you can sell and realize that cash. Okay. But don't go into these technicalities. We will see when we will stick to what, is being expected here. I hope, but the logic is clear to you. Now, this is one thing. Okay. Sorry. This was one thing that it will help you in long-term financing decisions. Then second benefit of having dividend policy is what? The second significance of dividend policy is wealth maximization decision. See, all the activities of a company that are actually directed towards the wealth maximization principle of the company as well as of the shareholders, because that is what the basic objective of any company is, correct? So what happens is, in this case only, if you see, the wealth will get maximized because the wealth, or let's say the investment, is happening in the right proportion to the investment opportunity, which is carrying 20% of the return. Okay, students. So this anyways is linked to the first point, but it will help you in the wealth maximization. Plus, there is one more point which is there, which says that if you see there is a shareholder, okay, that shareholder would always want that dividend should be paid today. Okay. Why? Because a rational shareholder feels that, okay, if the company is investing in any investment opportunity and let's say 10 years down the line, The realization comes and the company will pay me dividend after 10 years, not now, because the company is constantly, putting that money in the investment opportunity. They are reinvesting that money. So there is a risk, there is a form of risk that comes to that investor, is that, okay, what kind of cash flows they will have after 10 years, whether I will be able to get the dividend back, because cash what I have today in my hand is better than what I know is going to come in future. Correct. That's how they will expect the dividend to be paid today only. Okay. Hence, there is a theory which says that immediate dividend would lead to higher MTS. So, immediate dividend, if we say that there is an immediate dividend, generally it would lead to higher MPS. Okay. Okay, Pooja. Hitesh, wealth maximization, right? Neha is saying, I can't understand. So, Neha, is it about the long term financing decision? If yes, then we will be covering this particular concept in very detail. Okay. This is just, I'm trying to link the significance of dividend policy with these 2 points. That's all. Okay. We will cover and you will be able to understand that why we were, saying that we should invest in the 20% investment opportunity. Okay, Neha? Now, so these were the 2 significance of the dividend policy. Now, students, focus here. There is one more separate topic which I'm taking all of you through, the relationship between retained earnings and growth. So there is this term called growth, and which is very, very, very practical. Okay. Because all the companies today's work on growth model, whether it is a startup, whether it is a non-startup, whether it is an established company, because everyone wants growth. Now, what is growth? What is actually growth? In very simple terms, let's say this is the profit that you are getting in year 1, right? This is the average profit I have taken for the year 1. Let's say it is 100 crore. Year 2, you are getting the profit of 150 crore. So the growth is 50%, right? Or let's say 50 crore. In absolute terms, the growth is 50 crore. Or in percentage terms, it is 50%. Similarly, here you get, let's say, 220 crore. So here it is 70 crore. Okay, and somewhere the growth will be around 48 to 50%, whatever it is. Okay, so growth is actually higher than the previous year. So growth is always measured in relation to the previous year. Don't forget that. Plus, it is incremental to the current amount, right? So it is always measured as incremental to the current amount. Now, let's say this is the entire earnings for a particular year. Earnings for 1 year, right? Okay. Now, this is the entire earnings for 1 year, for example, 100 crore that we saw in the year 1. Now, out of this, let's say you still decide to pay some dividend and retain something in cash. So you take into 2 parts, right? So basically this much is dividend and this much is you are retaining it back. Now, please students understand it very carefully. I'm trying to link this retained earnings with the growth now. Now you are retaining this amount. Now, if you decide to retain, that means you will be investing it somewhere, correct? You will be investing it somewhere. Now, if you do that extra investment, you will be earning extra income because you are doing extra investment and the incremental income will come to you. So incremental income will be how much? This retained earnings multiplied by the ROI on that particular investment opportunity, right? For example, we have an investment opportunity which gives us a ROI of 22%. So we will multiply whatever investment we did in the form of retained earnings multiplied by ROI. So this incremental income is what? Growth is equal to retained earnings multiplied by ROI. I hope this formula is clear. This is one of the formula that we will be using in our practical questions. Okay, please don't forget growth is always incremental. It can be in profit, it can be in sales, it can be in anything. Growth can be in anything. The growth in profitability comes through higher investment and the ROI on that higher investment multiplied by ROI on that higher investment. Okay. Okay, so Mancha is saying this year budget amend the section, okay, to stop the practice of bonus stripping. Okay, Mancha, that I think in the corporate law sessions that would be, better expertise to tell. Hitesh is saying increase or expansion in the activities of a company which leads to increase in profit is growth of a company. That's correct, because it is leading to increase in the profit. We are not maintaining the same level of profit, but we are increasing it. You're absolutely right, Hitesh. Ban Reddy is saying 46.66%. Okay, this is actually 46.66%. Sir, what is the meaning of incremental to current amount? Okay, Karthik. So incremental to current amount is this only. So we said that year 1, there is a 100 crore profit. Year 2, there is a 150 crore profit. So the current amount is what? 100 crore. I'm saying growth is always in relation to the base year. Base year is year 1. Year 1, you got 100 crore. Year 2, you are getting 150 crore. So there is an incremental of 50 crore, which is called as growth. Correct. So the incremental to current amount for, let's say, if you're talking about year 2, then current amount will be year 1. If you're talking about year 3, then your current amount will be whatever you earned in year 2. Correct? So it is always in relation to your base year, because year 3, you will calculate the growth in relation to your year 2. Year 2, you will calculate the growth in relation to year 1. Okay? Mancha, this ROI is same as IRR. No. ROI is not same as IRR. IRR is a different concept and ROI is a different concept. So Pooja is saying step diagram is not clear. Okay, let me explain the step diagram again. So what I have done here is, I'm saying that year 1, the company is earning a total profit of 100 crore. Okay. So do you feel that in year 2 also the profit will be 100 crore only? No, right? Because the company is doing a lot of interventions through decision making, through operational decision making, through dividend decision making, through investment decision making, right? Through all these interventions, the profit will go up. That is what is expected from the company, right? So year 2, I'm saying, let's say the profit goes up to 150 crore. Hence, there is an increment of 50 crore here. Similarly, in year 3, the profit goes to 220 crore. There is an incremental of 70 crore here. That is what the step diagram I'm trying to tell you. Okay, Bharadwaj? Okay, Pooja. I hope this is clear. So this is just to tell you the difference, just to tell you the concept of growth. Growth is something incremental to the base. Simple. Growth is something incremental to the base. There can be a situation where in year 4, okay, now I'll bring some complexity to it. There can be a situation where in year 4, your profit actually declines. It again comes back to 100 crore. Then also there is a negative growth. You are degrowing in that particular case. Your negative growth is from 220 crore to directly to 100 crore. Okay, there is a negative growth here. Okay. Khushi is saying profit will grow at growing rate. Yes. Okay, Pooja, thank you. I hope it is clear. Perfect. Now, please remember this formula. This is very, very important. Growth is equal to retained earnings, which is the incremental investment, because your retained earnings is as good as incremental investment in your business multiplied by ROI. Now let's come to our main business, the main topic, which is theories of dividend decisions. The students, from here, the main guiding principles starts. Okay. Before this, we have just now created our base to understand these things better. Now just see how, the people who have created these theories think, and let's try to understand that. So there are all the theories we can club under two parts. One is irrelevance theory. Don't feel that this theory, the study of this irrelevance theory is irrelevant. No. The irrelevance theory name is just given so that it has a meaning, right? But the theory is very much relevant for decision making. Okay. Then we can club it under relevance theory, the second type of theories. So irrelevance theory is actually called as MM approach. This is Modi, Gilani and Miller approach. Okay. Relevance theory have 2 points, or let's say 2 models. One is Walter's model and second one is Gordon's model. Okay. Karthik, you're right. It in growth is just a way that something in addition to the previous year. Very nice. This is a very normal way to understand. Banreddy is saying yes, minus 54.54. Yes. If the profit comes from 220 to 100 crore in fourth year, it is this. So Gihani is asking, if negative growth happens, then what happens? If negative growth happens, then it means that the management has to take some corrective actions in future to correct that growth. If negative growth happens, definitely the price of your share in the market will go down. Correct? Okay. Now, we will first of all take irrelevance theory to discuss about the dividend decisions. Okay, so I'm taking MM approach first. So MM approach says that whatever we pay as dividend, it never impacts your market price per share. Okay. Irrelevance theory it says that whatever dividend is paid / not paid, it will not affect the value of the firm. Now, please understand this very carefully. So they are saying that whatever you pay as dividend or you not pay dividend, it will not impact the value of the firm. In short, it will not even impact the price, the market price. Okay. Now they say that, let's say the company is standing as on today. So it will keep on earning some amount, and slowly, gradually, the share price also will go up at the end of year 1. Correct. It is not that it will be like this. It will go directly on year 1 once the profit is declared. No. And then once the financials are out, it is not like that. It slowly, gradually keeps on increasing, right? That's how practically it happens. So they say that the value of the share price is always reflective of the earnings that are happening over a period of time. Now, assume here that at the beginning of today, let's say year zero, I'm saying today, it is 20 rupees. and slowly, gradually, it increased to, let's say, 40 rupees here. So what happens? The market price currently is 40 rupees, and today the company decides to give, let's say, 5 rupee of dividend. Correct? So when the company pays a 5 rupee of dividend, the market price will become 35, and 5 rupees will be the cash with the shareholder. Correct? So still the total value with the shareholder is 40 rupees. Correct? So I'll explain it here. Before dividend. Before dividend, how much value does the shareholder hold? 40 rupees, right? Because he was holding share. And this we are talking about in year 1, okay, which is end of the year. After dividend, after declaration of dividend, 35 is the value the shareholder holds in the form of a share, and 5 in the form of cash. Still the total value that the shareholder have is 40. So there is no change from the shareholder's expectation, right? Because 40 was earlier having in the form of value of the share, now 35 and 5. So it is just putting this 5 rupees from one pocket to another pocket. Simple. Correct. It is just I'm putting 5 rupees from here to another pocket. Now there are 3 cases that are given in this. I hope till now the explanation is clear. Okay. Now there are 3 ways in which they say that dividend can be paid. So the first way that is covered under approach is firm pays cash dividend using reserves and surplus. Okay. Whatever the firm is paying, they are paying it through the cash dividend, and they are using their reserves and surplus to pay that. Okay. Now this is as good as the example that we discussed just above. So 20 was the share price in the beginning, and 40 it became. So once it became 40, then 5 rupees was paid as dividend. Okay. Once this 5 rupees was paid as dividend, then 35 plus 5. So the value is still 40 for the shareholder. So this is the same thing that we just now discussed. Okay. Then there is second scenario as well, which says that firm pays dividend in cash using new equity shares. Now please understand this part. So what they say is that the firm is paying dividend, there is no doubt about it, but they will pay in cash. Okay, they will pay in the form of cash outflow, but they will issue new equity shares. Whatever the proceeds comes from that new equity share, they will use that to pay the dividend. So this is the process. Now please don't say that the issuance, the proceeds of equity shares we cannot use to pay the dividend to the earlier shareholders, or there is some regulation challenge, or it's not in compliance with the Companies Act. That is a separate topic. But here what approach says is that since they need funds, they will arrange the funds, and they will arrange the funds by issuing new equity shares. Okay, so issue new equity shares. This is step 1. Then step 2 is cash will be collected. Once this is done, then cash will be collected. And third step will be we pay dividend. The company pays dividend, correct? This is the third step, using that cash. So ultimately here, the value will be to the shareholder is share price plus dividend what he got, and minus valuation loss on account of dilution. There will be dilution, right? Because if I'm issuing new equity shares, the value will go down. Hence, if you see this will still be equal to what he was holding before the declaration of dividend. Okay, now let me take the queries. So Pandava Gayatri is saying, sir, do we need to study this theory from material also, or is it enough to understand from your lecture and solve the questions from material? Okay, Pandava, I have covered enough questions, almost all the questions that are given in your study material in this session. Okay, so you understand the concept here, and just for your, proper further understanding, I would suggest you read it from the material as well. Okay, understand, read, and then solve the questions. Mansha is saying, except from module page number 9.9, where IRR is greater than return required by shareholder, it would be advantageous for the okay. Wait, Mansha, wait. So, okay, this is, I think, in relation to what you asked earlier, that whether IRR is equal to ROI or not. Okay, you have to understand in which context are we using it. Okay, how IRR is used in capital budgeting, because I was thinking that you are asking from the capital budgeting point of view. So how we're using IRR in the context of capital budgeting, and where this IRR is used in the context of what in question, right? So we will see exactly what is there in the question. Okay, Mansha? See, now, whatever you are mentioning from the study material, in that context, IRR is as good as your ROI. Okay? Because they are saying that IRR is what is they will get as an ROI on that particular project. Okay, Mansha? Hitesh is saying the theory is saying that if dividend size increase, then also MP is same. Yes, the overall value is same. We're not saying the market price is same, because the market price has come down, right? If you declare a dividend, the same value dividend market price has came down. Okay. So Karthik is saying, sir, why the value of share fell down from 40 to 35? Because before dividend also I could get 40 against that share. Okay, Karthik. So it is a very simple phenomena, right? So once you declare the dividend, so there is a concept called X dividend price. And there is a concept called cum dividend price. So practically, if you see, let's say this is the share price moving, right? And here suddenly, let's say this 20, this is 40, and this is the record date. On record date, the dividend is declared, right? Whosoever is holding a share on the record date, they will get a 5 rupees of dividend. So the price existing immediately before record date is called as cum dividend price. Cum dividend price means it includes the dividend. And once the dividend is declared, then the market will open at 35 for that particular price, which is called as X dividend price, because 5 rupees is already paid as dividend. Okay. So that is why the price will move from 40 to 35 once the dividend is paid. I hope it is clear. Ban Reddy is saying, I have now doubt that how share price will decrease. Just now I answered Ban Reddy. I think your and Karthik question was same. Mega, how to notes prepare financial accounting? Mega, I'm not clear with your query. How to notes prepare financial accounting? Can you please elaborate, Mega, on your query? Okay. So I hope this concept of X dividend price and cum dividend price is clear. Now, please note practically, you cannot see the exact movement in price of dividend. But here, for our purpose, we are taking, because practically there are some other factors as well, right? So, but, logically, if you think, whatever was cum dividend price, it includes the dividend value. Once you pay the dividend, the market price of that particular dividend will fall. And then the third case that is given under approach is firm don't pay any dividend. This is very simple. If they don't pay any dividend, then already the price is 40 rupees, correct? Already price is 40 rupees. That is where it will not impact the dividend. Just a second, students. Okay. Now, let me take an example to make you understand all these things. See, the theory is a bit, the theory is a bit difficult to understand, but the examples or the questions are very easy and straightforward on this. Karthik is saying, okay, so appreciation in the market price includes the value of dividend also. That means people while buying shares do consider the dividend that they will get on the particular share or for which they are. Yes, definitely yes. That includes the value that is accruing to that particular company every day. Because the company will pay dividend using that accrued value only, right? Which slowly, steadily increases. Now, in this example, I am assuming that there are 2 lakhs of equity shares. And let's say their issue price was rupees 10 per share. Okay. Okay, Karthik. No borrowings. And the company have no borrowings currently. And there is a policy that all reserves and surplus is invested back in capex. There is a general trend that whatever reserve and surplus they get, they will invest it back, and they are currently not having any borrowings. Cost of capital is actually 10%, which is KE, the expectation from investor. So now we will try to understand in all the 3 cases that we have just now studied. Okay. So market price, how we compute this? So P1 is the price at the year end. The price at the year end will be the price which is today plus appreciation on that, correct? Minus dividend. This is just now what we discussed, right? Why we did minus? Okay, Bandredi is saying capex. Sorry, I have not explained this term. Capex is your capital expenditure. Capital expenditure, which is nothing, but please understand that this is another kind of investment only. This is some form of investment. Okay. So they invested back. So they invest, let's say, in plant and machinery, land building, something. They will invest. Okay. So can I write this as this? P0, 1 plus KE minus D1. Yes, Hiral, you're right. Hiral is asking in MM approach only equity share capital and not debenture, and hence there is no requirement of calculating cost of debt. Yes, KD is not required. Yes, that's right. K is the only thing required. So this gives our first formula. Okay, so the P1 is actually the price at the end of the year. At end of the year. P0 is what? Price at beginning of the year. K is actually cost of capital. So 10 rupees today will become 11 rupees because 10% is the cost of capital. So 1 plus 10%. D1 is equal to dividend paid in at the end of first year. Okay, now if we substitute everything here, so 10 was there, 1 plus 10%, and in our example, we are paying 0 dividend, correct? So the price becomes as 11 rupees and the value of firm becomes 11 multiplied by 2 lakh shares, right? Which is 22 lakh rupees. This is the value of the firm. Raghavan is asking, sir, if a company pay dividend, then expectation of new shareholder also increase. If K increase the value of the firm also to Increase. Okay, I'll touch that topic, Raghavan. Well, I will discuss that case study. I mean, the discussion on KE and ROI or slash IRR. Then I will take up your point. Okay, Raghavan. So the value of the firm is given as 20 is computed as 22 lakhs if we don't pay any dividend. Now let us take the second case here. We said that it pays dividend using new equity shares issued, right? Using new shares proceeds, and the dividend is rupees 3 per share. They decide to pay rupees 3 per share dividend, but they said that they don't have any cash because whatever they are earning, they are investing it back, right? They don't have anything with them, so they will issue new equity shares for paying this dividend. That is what the approach also says. Approach says, right? Now I'll tell you how the calculation will happen. Again, we will apply the same formula. The price at the end of the first year, because we have to calculate the value of the firm, the value of the company, right? Because we have calculated value of the firm, which is company, I mean to say company here, is equal to 22 lakh. What we are trying to prove is that in all the three cases, value will be 22 lakhs. Okay. So P1 is equal to 10, 1 plus 10% minus 3. So in this case, I'm not putting 0, I'm putting 3 because 3 rupees is the dividend that we have to pay. So if you solve this, 11 minus 3 is equal to 8. So the price at the end of the first year should be 8 rupees as per the formula. Neha is saying, why are we adding 1 to the 10 percentage? Okay. So Neha, it is just your, because we have to take, we don't have to take the incremental value, but we want to see that where this 10 is moving. See, you can write like this also as well. 10 plus 10 percentage of 10. This is what your value at the end of 1 year will be. Correct? So this is what 10 plus 1, 10 percentage of 10. Correct? So this is 11. Or in short, what mathematically we have done is we have taken 10, 10 outside as common, 1 plus 10% we have taken here. Simple. So this is the mathematical solution. Hitesh, your answer is correct. Siddharth, sir, can you give the example with the same values when dividend is paid using reserves? Okay, wait. We will come to that. The third case is that only. Okay. There are questions on that as well. Okay. So we will come to that. So P0 and P1 are the market prices per share. These are not the book prices. Okay. But again, Mancha, we will have to see it from the context. Generally speaking, these are market prices. Okay. Generally speaking. But sometimes if the question directs you, so please don't hesitate and take these things as value as well. Because see, we are using cost of equity here. Cost of equity is always from the market perspective. Hence, my conclusion is that this is always the market price. Okay, but you never know where question will direct you. Okay. Okay, done. Now, the price comes as 8 rupees. So can we now see that what is the new number of shares? New number of shares required to be issued is equal to 2 lakh into 3 is what you have to pay the dividend. Correct? This is your total fund requirement. 2 lakh into 3 is your total fund requirement divided by 8 rupees. This section is separate, not part of the solution. So new number of shares required to be issued is the total fund requirement divided by the price per share of 8 rupees. That comes as 75,000. Very good, Hitesh. Your answer is correct. Pooja is saying 10% is equal to 1.1, right, sir? So 11.1, have you taken the rounded off value? No. Wait, Pooja. See, if you open this bracket, then what it will come is 1 plus 0.1. Correct? Because 10% can be written as 0.1. and hence 10 1.1, 10 multiplied by 1.1 will give you 11. Okay, so we have not taken any rounded off value. It is coming from the calculation only. Sir, in case 2, isn't it possible that as the supply of shares, Karthik is asking this question. Sir, in case 2, isn't it possible that as the supply of shares in the equity market, as the demand force will act, the price of the share might fall down and the dividend expectation somewhere help in upward movement of the price. So somewhere the market price at the end doesn't increase but remain constant. It is possible. Okay, Karthik, let me tell you. As I told you, in this case also, practically there are other factors which impacts the prices. Cum dividend and ex dividend. The difference between cum dividend price and ex dividend price will always not be equal to the dividend. But for our study purpose, we will always assume it is equal. Now, what you are also saying is right. Practically, there will be other factors. There will be supply-led factors, demand-led factors. There will be a lot of things that is happening in the market that will impact the prices up and down. Okay, but the thought process here is that whatever is the value included in the cum dividend price, the same is reduced to arrive at the ex dividend price. Bandredi, your answer is correct. Pooja, what is the small confusion? Tell me. I hope this is clear, right? There is no rounding off. What we are doing is 1 plus 10%, we are mathematically putting at 1 plus 0.1, which is 1.1. 1.1 multiplied by 10 is 11. Okay. Okay. Now let me add a sheet here. Perfect. So we came to know that, okay, 75,000 is the new number of shares that we need to issue. Okay. Now, can we calculate the value of the company after all this? Yes, we can calculate. What is the price per share? 8 rupees. How many are the total shares? 2 lakh were earlier there and 75,000 we have newly issued. Right? So 8 multiplied by 2,75,000. So this gives you 22 lakh rupees. Again, the value is same as what we got in step number 1. Correct? So 8 rupees is what the share price will be. And number of new shares is 75,000. So it is same. Now using this, now we are driving one formula. Now please students note here. This we already know. Correct? Okay, Pooja, perfect. Hitesh is saying 22 lakhs, which is perfectly fine. Okay, I'm happy that at least all of your doubts are getting cleared because that is what my objective is, right? And that is what our objective should be. So this is what we already know. P1 is equal to P0, 1 plus K minus D1. This is the simple set standard formula. Now, can I say that P1 plus D1 is equal to P0, 1 plus KE? Okay, I'm just moving D1 here. And now P0 is equal to P1 plus D1 divided by 1 plus KE. Is this also right? Correct? I have moved this multiplication here to the division in the next step. Okay. Yes. Okay. This is mathematically correct. I can write this. This is 1. If we multiply in this equation with the number of shares, okay, to arrive at the value of the firm, then because see, what we are doing here is we have calculated the value of the firm, not only the price per unit, right? So can I say that N is the number of equity shares? I'm multiplying it in PO, which is the P0, which is the price. Or I can just say that this is the value of the firm, correct? Whichever way you denote is equal to N plus delta N P1 minus investments plus earnings divided by 1 plus KE. I'll tell you. But please, as of now, note this formula. I'll exactly tell you the reason of all these things. Okay, please don't get confused here. As of now, just write this. I is equal to investment required. E is equal to earnings. Correct? Delta N is equal to the new equity shares to be issued. Equity shares to be issued. Let me write it properly. Then N is equal to existing number of shares okay, and VF, we already know that this is the value of firm slash company, whatever we are talking about. Anything I've left? KE is equal to the cost of equity. Okay, fine. See now, let me tell you how this, on what basis this formula is working, or let's say directionally what this formula is doing for us. Let me write it here again. VF is equal to N plus delta N P1 minus investment plus earnings divided by 1 plus KE. So, and this is value of the firm as on today, correct? Or I can say this is the present value. So first of all, students, if you see, we are dividing this by 1 plus KE. So division by 1 plus KE means that we are bringing the future value to present value, correct? Let's say this is the 0 period, this is the first period. So first of all, there is this some value that is here, which we are bringing to the present value here. That is why we are dividing by 1 plus K. That is understood. Now, what is this value? This value is numerator, right? This value is numerator. Numerator, what exactly is there in numerator? In numerator, the value is that whatever is the total value of the firm, which is this, plus how much earnings we will do, because that is also something extra that also we have to add, correct? And minus investments, because something of this investment will be funded from the earnings itself. So we have to take both of these factors as well while we want to know that what is the end of the 1 year value that we hold as a firm, and that we are doing in present value and taking it as on today. Because see, your today's investment will not have this investment and will not have even these earnings, but your 1 year from now value will have even these investments and also will have an impact of these earnings. Okay, so Siddharth is saying why we are dividing 1 plus K and how we are arriving at the present value. Simple. How do you calculate the future value? Right? And how do you calculate the present value? This is the present value and this is the future value. So anything from future to present you have to do, then you have to divide it by the 1 plus K raised to the power how many years it is. In this case, it is 1 year, and hence I am not putting that raised to the power 1. Okay, Siddharth? Mancha is saying numerator consists inflows minus outflows. To some extent, yes, Mancha. If you ask me, this is that only inflows minus outflow, the net cash. Let's say the net cash required or the net cash surplus available. So E minus I is that only. And this is the hypothetical value that you will get at the year end. Okay. Now let's cover one of the question to understand it better. Okay. Now, please concentrate here. The question is very easy and it is very systematic and structured. So AB Engineering Limited belongs to a risk class for which the capitalization rate is 10%. They have told you, okay, the capitalization rate, cost of equity is 10%. Okay. It currently has outstanding 10,000 shares selling at 100 each. This is price. Now, if you see Mansha, to your question, this is selling at 100 rupees this is the market price. This is not the book value. Okay. And hence we are also using the cost of equity here. The firm is contemplating the declaration of dividend of 5 per share at the end of the current financial year. Now, they have given you a very clear problem statement. They are saying that they are contemplating to declare a dividend of rupees 5, right? They have not decided, but they are discussing it. It expects to have a net income of rupees 1 lakh. Income they are expecting to have 1 lakh. Just a second. And a proposal of making new investment of 2 lakhs. Calculate the value of the firm when the dividends are not paid or are paid. Simple. We will start with our simple solution. We will take first case. In case dividends are not paid. See what they're asking us? They're asking us to calculate the value of the firm, which is just now we saw the formula, right? Value of the firm. This is the formula. Correct? Okay, the value of the firm. Okay, very good question from Hiral. I really appreciate the kind of questions that are coming. Wait, let me first answer that question. Sir, why are we calculating the value of the firm using second formula? In previous example, we simply multiply the P1 with the number of shares. That is correct. I'll tell you. Here, they are asking about the value of firm as on today. In my example of that, where I have taken 22 lakh rupees, I have calculated the value of firm as on that date. Wait, this was the example, right? In this case, this value had come at the end of that year one. Even this value of 22 lakhs had come at the end of the year one. But in this particular case, we are trying to calculate the value as on today, and hence we have to do all these adjustments. Similarly, in this question as well, we are estimating as on today what is our future proposal for investment, what is our future investments, what is our future earnings, how much dividend we should pay. Hence, we are trying to calculate the value of the firm as on today. Okay. In case the dividends are not paid, first of all, we have to calculate P1. P1 we know that will come through this formula, right? And P1 is equal to P0 is 100, 1 plus 10%. In this case, we are seeing 0 dividend, and hence P1 comes as 110 rupees. Hitesh, you're right. P1 is 110. Perfect. Now in step 2, this is our step 1 for part 1. Okay. Now step 2, we have to calculate the calculation of funds requirement. See, we have to calculate the funds requirement, right? Okay, we have to calculate the funds requirement because we have some earnings planned, we have some investments planned, we have some dividend planned. So we have to see that what is the value of the funds requirement that is coming out to be. First of all, we need investment for investment purposes. We need how much? We need 2 lakh rupees, right? but we will get from our earnings as 1 lakh rupees, right? So the net amount required is 1 lakh rupees. Are we paying anything for dividend also? For that also we will need funds, right? In this case, nil. So hence the net amount required is how much? 1 lakh rupees. And number of, now step 3, can we easily calculate calculation of number of new equity shares, because as per the approach, we have to issue new equity shares only, correct? So this will be the fund requirement of 1 lakh divided by what is the price? 110. Number of shares is equal to this much. I'm not solving it. Okay, I'm keeping it as 1 lakh by 10, 1 lakh by 110. So the number of new equity shares required is 1 lakh by 110. Okay. Now, final step, step 4, calculation of value of firm. So value of firm is given as n plus delta n, P1 minus investment plus earnings divided by 1 plus KE. So value of firm is equal to, how many were the existing number of shares? 10,000, right? 10,000 were the number of shares, plus new shares were 1 lakh divided by 110, multiplied by 110, which is P1, minus investment required was 2 lakh, plus earnings were 1 lakh. This whole divided by 1 plus 10%. It is very easy. You have to just put everything in this formula to calculate the value of the firm. So it comes as, if you solve this, it comes as 10 lakh. This is as on today. Okay, because I have not solved this is now if we open the bracket, so this 110 and 100 will get cancelled, right? And similarly, this 10,000 will get multiplied by 110 and then it will get added. Okay. Now we will take the second part. When dividend are paid. This is 5 per share. How much dividend we have paid is 5 per share. Okay. Now again, step 1. P1 is equal to 100, 1 plus 10% minus 5. Correct? So P1 comes as 105. Step 2. Step 2 is funds requirement. So funds requirement, investment is 2 lakh rupees that we need, minus earnings. Already we know that earnings we are getting 1 lakh rupees, and this time there is a dividend as well. Dividend payout is 5 rupees on 10,000 shares. Which is 50,000 rupees additionally we need for dividend. Hence the net fund requirement is 1,50,000. Yes, Hitesh, you are right. Value of the firm is 10 lakhs. And second is also 10 lakh. Very good. You have calculated it. So the number of shares, sorry, amount required is equal to 1,50,000. And hence the number of shares is equal to 1,50,000 divided by 105 this time, correct? Because the price is 105. Then final step, value. This is actually step 3 and this is step 4. The value is existing share of 10,000 plus additional share of 1,50,000 divided by 105 multiplied by 105 minus investment of 2 lakh plus earning of 1 lakh whole divided by 1 plus 10%. Hence the value here also is 10 lakh only. So hence proved under approach, Modi, Gilani and Miller approach, that whether you pay dividend or whether you not pay dividend, ultimately your value of the firm will remain same. I'm not saying that market price will remain same. No, market price will change. Why? Because in the previous case, the market price was how much? Okay, let me write it here. No dividend. Yes, dividend. This is, I'm just comparing both the scenarios under approach. Okay, if I pay no dividend, then market price was how much? 110. Here the market price was 105. Value of the firm was how much? 10 lakhs. Value of the firm was how much? 10 lakhs. Okay, so simply this we are talking about P1 MPS, right? Because P0 MPS will be same, which is 100 and 100 in both the cases. So ultimately, approach said that value of the firm remains same, and what is meant by value of the firm is what Karthik is also asking. Karthik, value of the firm is simply what is the right present value of the value of the firm that you are going to have in 1 year from now, and the value of the firm 1 year from now is equal to the price that we expect to exist at that point of time, depending whether we pay dividend or not, and depending on other cash flow factors. Other cash flow factors is your investment and your earnings. Okay. Hiral is asking, sir, can we calculations of P1 by using first formula? Yes, Hiral, we have to calculate P1 by using first formula only, which is this. The formula is here, sorry. Yes, this one. We have to calculate the price at the end of the year 1 using this formula only. Okay. I hope approach is clear. Okay, Siddharth is saying, please give the case of one of dividend paid out of reserve with reference to first example figures. Okay, now I am coming to that question, Siddharth. So Siddharth, if you see in this case also, we have paid a dividend. Okay, I'm just relating this, whatever your query you have, to this example only. We have paid a dividend here as well. And if you see, ultimately, our fund requirements are adjusting for both, right? Whatever earnings we have done and whatever dividend we have to pay. Ultimately, can I say that if there is, in this question itself, if investment is not given, let's say investment is 0. So can I say that your earnings is 1 lakh and your dividend payout is 50,000? Hence, you are paying 50% of what you are earning. Correct? That means 50% of what you are earning is getting paid from your earnings itself. And hence, this is the same example. I mean, this you can relate as the same example, right? This is also dividend paid out of your reserves. Correct? In case you pay dividend out of your reserves, the first impact comes on your price, which is going to happen after 1 year. The second impact comes to the number of new equity shares that you are going to issue. And hence, it will negate any impact and bring back the same value of 10 lakh rupees. Okay? Okay, Siddharth? And also, just to satisfy, I mean, whatever you're exactly asking, I can also give you an example in this example only, which I've taken. Yes, so in this we have paid the dividend using new share proceeds, right? In this only I am taking a third case here. So if you see third case, if you pay dividend, correct, then what was our figures here? So let's say 3 rupees you are paying dividend, correct? So then in that case, your cash flow becomes what? Sorry. Yes. Your cash flows. Wait. 10, 1 plus 10 percentage minus 3. Correct. And this 3 you are paying using your earnings. Correct. But in the question, since I assumed that whatever you are earning or investing, that means your investment will fall short by this 3 rupees. That means at least for investment, you have to issue the equity shares. That is what approach assumes. Whatever is your shortfall, you will, because it will say that it is saying that all the earnings you invest back into your business, see whatever incremental you want to invest, and see what incremental you want to pay as dividend. Okay, Siddharth? So hence, we can calculate this price as, let's say, 8 rupees back again, but for compensating the payment of dividend from reserves of 3 rupees, our investment will fall short by 3 rupees, and hence for investment we have to issue another equity share for compensating this 3 rupees. Okay. Mancha is saying how the calculations to be made for unlisted companies. Mancha, for unlisted companies, there has to be a valuation that has to come, right? I mean, the only difference between listed and unlisted companies in all these examples is that listed companies you have a very well number, the very well market price that comes from the stock exchange, but for unlisted companies, you don't get it. Hiral is asking, I have doubt in some of study material written study analysis. Will you do study material? Some number 4. Okay, Hiral, please remember this query in the next session, because next session is a revisionary session. We will take that. Okay, Hiral? So we will break for 10 minutes. We will again come back at 7:31. So welcome back, students. There is one question from Siddharth. So it means that instead of shares to be issued, amount will be given from reserves, and thus the value of the firm is just the same. That's correct. So the value of the firm remains same because see what Modi, Gilani, and Miller approach says that even if you have to pay a dividend, you will have to issue a new equity share. Okay. And if you decide not to issue new equity share for the payment of dividend, then you will fall short of the investment amount because that earnings amount that you would have invested, you are now paying it as dividend. So for that short amount that you are having for investment, again you have to issue the equity shares. So the equation remains same. That is investment plus dividend payout minus earnings. That is your net cash required. Now, Divyanshu Manchanda has asked a very good question. Even value of the firm at the end will remain same. Yes, the value of the firm at the end also will remain same, which is what? Which is n plus delta n multiplied by p1. Simple. Okay, this is the value of the firm at the end of the period, and at the beginning of the period, if you adjust those adjustments that we discussed, it will give you the value of the firm at the beginning of the period. Simple. Okay. Okay, now, Hiral, on your question regarding this scenario analysis in the study material, please do ask the same question specifically in the next session. Okay, we will take that. Now, let's come to the second part. I think more or less the irrelevance theory is completed. We will attempt further questions for the practice, but for the concept building, I am coming to the second model, which is Walter's model. Okay. Now, students, please listen very carefully. So Walter's model is a relevance theory, is a part of the relevance theory. It says that whatever you pay as a dividend, it will impact the value. So the dividend decision is a relevant decision for the valuation of a company. Okay, in other words, I can tell. So we know that actually, if you see in the price, if you multiply it by cost of equity, then can you get dividend in the form of a return? I am assuming that 100% return is equal to dividend. Okay, this is very simple. Correct. Is there any doubt about it? No, right? In the price, if you multiply it by the cost of equity, you will get the dividend amount. Correct. I am assuming in this particular case that dividend is 100% of your expected earnings. The cost is 100% being paid as dividend. So if you want to calculate price, then can we do like this? Dividend by cost of equity. Correct? It is fine. Now, since I assumed 100%, whatever earned by the company is paid as dividend. So what about those cases where we are not paying 100%? We are retaining something. That means I have earned 100 rupees, but I'm paying dividend as only 20 rupees. That means on 80 rupees, I will get some incremental earnings. There will be some kind of incremental earnings that I will get. So hence, what I will do is, I will just take earnings minus dividend. Correct? Because now in this case, I'm assuming that what about those cases where we are not paying 100% dividend? So let's say 20% dividend is paid, for which the value is this, and balance 80% is this. On this, we will get R times the rate of return, which is the ROI, the rate of return, or let's say the IRR only in this context, divided by cost of equity. Because see, we will get this as a growth amount, right? This is what? This is growth. This is the incremental amount, correct? So we have to present value it, and whatever that value comes as the final present valuation of that. So this divided by KE, why we are doing is to compute the relationship between R and KE. Okay, now I'm just trying to write that formula in a proper manner given by the Walters model. It says a dividend plus earnings minus dividend multiplied by R divided by KE whole divided by KE. This is the main formula that you have to remember from Walter. Okay, as I explained you, the price is computed is a combination of what you pay as dividend and what you reinvest back into your business. On that, you have to take a multiplication of return and divided it by the cost of equity. And finally, you're dividing it to take a present valuation of the same. Or let's say in this example, as I told you, that if you want to calculate the price, you will divide it by KE, right? For following the same logic, we are doing it here. So P is equal to price of the share R is equal to rate of return. K is equal to cost of capital. So this cost of capital is the expectation from the shareholder. Rate of return is the actual reality, how much we will get. E is equal to earnings. D is equal to dividend. Neha is asking what is calculate in this topic. Neha, I'm not able to get you. Can you repeat your question, Neha? Mansha is saying, what is the criteria for choosing these theories? What is the criteria? How to guide the organization in this regard to maximize the shareholders' wealth? Okay, I'll tell you, Mansha, practically, you can apply anything depending on the facts and circumstances of the case, right? Now, if you ask me, the relevance theory is also outdated and there are new theories around the dividend decisions. Correct, but it gives you an understanding. What understanding it gives you that your price is always reflective of dividend and whatever incremental you are going to earn in the business. However, the approach said that whatever you do in form of dividend, the valuation will remain same. The value of the firm, the value of the company will remain same, because whatever is your shortfall, you will have to issue new equity shares to do amount good for that shortfall. Okay. So that is a very difficult question to answer, Mancha. But yes, for us to pass our examination, yes, we have to understand these and we have to understand the logics as well. Okay. So yeah, so this is done. Now we will just quickly understand what is the relationship between dividend okay, and market price per share. Okay, we'll cover that now. So there are two things, right? R is equal to rate of return on the investment, or for this purpose we are saying that it is IRR, because IRR is also as good as the rate of investment while you talk about the dividend decisions. Okay, K is equal to cost of capital. This is the expectations from the shareholders. Correct. Now I am building three cases here. So first of all, dividend payout. What is the optimum dividend payout? What is the relationship between dividend and market price per share? And these are the scenarios. Okay, so scenario one, I am taking, let's say, growth case. What is a growth case? So growth case is a situation where your rate of return is greater than cost of equity. That means you're able to generate more return compared to the expectation of the shareholder. Then shareholder will say that, okay, since you're earning more than what I expect, you keep that in your business and keep on reinvesting it and get me returns. So in this case, if I pay higher dividend, the market price will come down. There is a negative relationship, right? And dividend payout should be zero. This is the optimum dividend payout ratio. It should be zero. In case of constant case, Constant case is where R is equal to KE. There is no difference. Whatever I expect, your business earns that. So the relationship between dividend and this, there is no correlation itself. There is no correlation only, right? Whichever way dividend is paid, market price is not dependent on that. So dividend payout ratio is any ratio is optimum. I can pay 50-50, I can pay 10-20, 10-90, I can pay 90-10, whatever is the ratio I can pay. Then third case is of the declining case, where R is less than KE. In this case, whatever shareholders expect, I'm not able to get the same return from the business. The business is giving me lesser returns. That means the dividend should be paid out. Less and less amount should be invested in the company. The more amount should be paid to the shareholders, right? So the higher the dividend, higher will be your MPS. So it has a positive correlation. And the dividend payout ratio should be 100% in this particular case. Neha is asking calculate price or calculate dividend. No, Neha, in this particular case, we are calculating price only. So the Walters model has given us the formula to calculate price. However, in question, if you are given price and you are asked to calculate dividend, you can apply the formula and calculate the dividend as well. Okay. So I'm just repeating these scenarios. I think this was one of the questions from someone also, from one more student. I told that student that we will cover this relationship later. And hence I'm saying that this R is as good as your IRR as well. Cost of equity is the expectation. Now, if I'm earning more than the expectation of the shareholder, shareholder will tell me that, okay, you keep the money in your business because you're giving me more returns. And hence I want zero dividend. Hence the dividend payout is zero. If business is earning less than the expectation, then shareholder will say that, okay, you give the earnings, whatever you're doing, don't reinvest in back in the business because what I'm expecting is higher than what you're earning. Okay. And then if R is equal to KE, then there is no correlation. Whatever I pay, it will not impact the market price. Whichever ratio you want to pay, you can do that. Hiral is asking, please explain the correlation concept in this type of sums. Okay, so the correlation concept here is nothing but, see, mathematically, can I tell you, Hiral? See, mathematically, what is correlation? Or let's say statistically. See, there is a term called covariance. Yeah, in the previous session, we studied that what is risk? Risk is equal to variance or standard deviation, right? So variation of what? Variation of estimated returns from expected returns. Estimated returns of whom? Let's say X Limited share price. Expected return of what? Of X Limited share price. Okay. Now I'll tell you what is covariance. Covariance is deviation of estimated returns from estimated returns. Okay. But estimated returns of X Limited with estimated returns of Y Limited. Simple. The formula exactly remains same. Okay. Okay, Mancha, let me actually see that part. Okay, let me see that part, Mancha. Okay, so this is what its covariance is. And hence, through this covariance, we calculate the correlation. Okay, so there is no correlation. Whatever we pay, it will not impact your market price. Mancha, let me check that thing. Maybe I'm not able to understand. Okay, let me check and come back. Maybe in this session or maybe in next session. Okay, because next session is also our revisionary session. There is at least some confusion that is there. Okay, but see, the concept here is very similar. Whatever you are getting as a rate of return, you have to compare it with the cost of equity and then take your decision. Okay. Now let's go back to our second question. Yes, so this is based on the Walters model. Yes. So it says that X Limited earns rupees 10 per share. The earning is given, right? The capitalization rate and return on investment are 10% and 12%. So the capitalization rate is KE, which is 10%, and the return on investment, which is R, is equal to 12%. Determine the optimum dividend payout ratio and the price of the share at the payout. See, first of all, what is the optimum dividend payout ratio? Now, students, please answer. R is greater than KE, correct? Because 12 is greater than 10%. So the optimum dividend payout ratio is zero dividend, correct? So we can say that since R is greater than KE, the optimum dividend payout ratio would be zero. Okay. And second, it is also asking us to calculate the price of the share at the payout. So the price of the share using the Walters model, can we calculate that? So we have just now concluded that dividend is zero, right? How much we are earning? 10. What is the rate of return on that 10? 12%. What is the cost of equity? 10%. Whole divided by 10%. This is our formula, right? I'm just writing the formula here. D plus E minus D multiplied by R divided by KE whole divided by KE. Okay. So if we solve this, then our answer comes as price is equal to 120. Very good, Siddharth. Don't pay dividend, zero. Hitesh, your answer is right. Price is 120. Perfect. Okay. Now let's go to the next illustration. Question number 3. It says that the following figures are collected from the annual report of XYZ Limited. Net profit is 30 lakhs. Okay. Outstanding 12% preference shares is 100 lakhs. Number of equity shares is 3 lakhs. Return on investment is 20% and cost of capital, which is KE, 16%. So here also R is greater than KE. That means better to invest in the business because 20% you are generating from business and 16% is what is expected by the shareholder. Compute the approximate dividend payout ratio. We have already computed, right? Okay, wait. Please read the question again. Compute the approximate dividend payout ratio so as to keep the share price at 42. Okay, so they are not saying that you have to make your share price highest. If you want to make your share price highest, you have to keep your dividend payout ratio as zero. But they want to keep the share price as 42. We will use the formula of Walter model. Oh, sorry, yeah, Walter's model. E minus D R divided by KE whole divided by KE. So we'll put the numbers whatever we have. So P is already there 42. Dividend is what we have to calculate. Earnings, let us calculate. So here I'm calculating the earnings. Calculation of earnings. So we are given that net profit is how much? Net profit is 30 lakhs. Less preference dividend. So students, I hope all of you know that while calculating the earnings per share, we always remove the preference dividends, right? Preference dividend is how much? On 100 lakhs, 12% is the coupon rate, right? Yes, 12%, 100 lakhs. So 12 lakhs we will reduce and hence 18 lakhs is the earnings for equity shareholders divided by number of shares. Number of shares are how much? 3 lakhs. Hence EPS is 6 per share. Okay, we can just simply put this 6 minus D here, correct? Multiplied by 20% divided by 16%, whole divided by 16%. I hope the numbers are correct. So if you solve this, then your dividend comes as 3.12 per share, and hence your dividend payout ratio comes as 3.12 divided by 6 into 100, which is 52%. Okay, Raghavan, on this IRR thing, let me see, because again, I told you now that this IRR is again has to be seen from the context side. So Raghavan is asking, sir, IRR is that rate at which NPV is zero, so ROI should be IRR. How are we assuming both are same? So he's saying that ROI should be always higher than IRR. Okay, see, IRR, okay, I'll explain you what is IRR. Simply, IRR is the rate at which your net cash inflows is equal to your net cash outflows. That means that is the minimum rate at which, or let's say an investor, or let's say the person who is putting that money into that project should expect the return. Okay, then only he will be able to make some money out of it. Otherwise, at if something he is actually getting in return below that, then he is not able to get a return out of it. So I'm saying, students, I request all of you, please do keep IRR separate as of now. The concept here being taught is only on ROI, which is return on investment, which is rate of return. I will separately answer Mansha's question, which is there on IRR. Okay, in the dividend decisions, we will restrict our discussion only on ROI, okay, or rate of return. Hitesh is saying EPS is 6, perfect. Hiral, why we take? Okay, so Hiral, okay, you are asking that why we take 25%, 50%, 75%, and 100% as optimum payout ratio. Okay, you must be asking for this question, right? In our study material, we have just taken to prove that, correct? Because we are saying that it is zero. So if you take 25% payout ratio, then what is your price? 50%, what is your price? 75%. In all those cases, your price will be lesser. Your highest price of 120 will come only in this case. Okay. Since it is not asked in the question, I have not included that, but that is taken only to prove that zero payout ratio is right. Okay. So Mancha is saying how to adjustment amortization amount. How to adjustment amortization amount. Which amortization amount? Are you are you asking about this or what? So Mancha, can you please elaborate on your query? Hitesh is saying D is equal to 3.12, which is perfectly right. Hitesh, your answer is right, 52%. Siddharth, so basically IRR is a break-even point for profit. Yes, Siddharth. IRR is a break-even point at which your cash inflows will be equal to your cash. Present value of cash inflows will be equal to your present value of cash outflows. Okay. So please, students, note that IRR as a concept is more relevant for capital budgeting thing. Here, we always see that what is the return that we are getting on that particular investment. It can be IRR, it can be higher than IRR, it can be lower than IRR. Okay. But I will come back to Mancha's question separately. Now, let's come to the Gordon's model. Okay. Now, Gordon's model, what does it say? First of all, Gordon's model is also part of the relevance theory, right? So first of all, we have to understand it from the context that Gordon also says that whatever dividend you pay, it is relevant for the valuation of a company, and hence it will change the valuation of the company. So Gordon has changed that formula to some extent in this sense. I will explain you. Okay. See now, students, for one moment. Okay, for one moment, I'm just doing some changes in this equation. The equation is this only, what you are seeing here. So can I do it like this? Ke minus Br is equal to E1, 1 minus B whole divided by P0. Okay, I've just taken the denominator here to P0's place, and P0's I've taken here in the denominator. This is okay. Then can I say that Ke is equal to E1, 1 minus B divided by P0 plus Br. Now I'll explain this equation, so automatically you'll be able to understand this, the first equation, right? Now, what is this KE? See, KE is the expectation of a shareholder. What a shareholder will expect? Number one, earnings. 1 minus B. So B is actually the retention ratio. So basically, if I just have to tell you what is B here is the retention ratio. How much we are retaining. So that means 1 minus B is your payout ratio, correct? So ultimately this is dividend. And this is growth. Simple. So the investor is expecting dividend, and dividend divided by price will give him, let's say, percentage. Let's say this is 10%, plus he will also expect a 5% growth. BR is what? BR is growth, right? B is the retention ratio multiplied by rate of return. And this, how I am telling this is a growth. Let me go back here where I explained you the concept of growth. Wait. Here it is. Yes, this one. B into R. Retained earnings, retained, which is B, which is the retention ratio multiplied by R, which is growth. Correct? So I hope this KE definition is clear, right? Because he will expect 15% in such a way that whatever he's getting dividend and whatever, see, P0 is what? P0 is his investment, because he's investing as on today, and D is what he will get as a dividend. Plus he will expect something for growth as well. So hence we can calculate P0 through that equation, and this is the equation that Gordon has given. Okay. So Gordon said that E1 multiplied by 1 minus B, which is the dividend payout. If you see, this is the dividend payout. I'm just writing that equation again here. P0 is equal to E1 minus B divided by KE minus BR. Okay. So P0 is equal to price of the share. B is equal to retention ratio, which simply means percentage wise how much are we retaining. One minus B is dividend payout ratio, correct? If B is retention, then 1 minus B is dividend payout, correct? KE again is cost of capital, and R is equal to rate of return. And BR is equal to growth rate. Okay. So Gordon also said that if your R is greater than KE, that means you are a growth firm, and hence your dividend payout should be 0. If you are a constant firm where R is equal to KE, it can be any ratio. And if you are a declining firm, again the same concept which Walter has also said, R is less than KE, then it should be 100%. How we can prove it from here as well, right? Okay, now this is what Gordon said. Now let us go to the next question just to see the application of this formula. Okay, yes. The following figures are collected from the annual report of XYZ Limited. 30 lakhs is the net profit, then preference share. Again, the same figures are given. Calculate the price per share using Gordon's model when dividend payout is 25, 50, and 100. They have given you three different dividend payout ratios. Okay, and they are asking you to calculate the price per share. Simple. So first of all, we know that P0 is equal to earnings 1 minus B divided by KE minus BR. Now, B will be what? There are three cases, right? 25%, 50%, and 100%. So B, which is the retention ratio, in case the dividend payout ratio is 25, so B will be 75, 50, and 0. 1 minus B will be 25%, 50%, and 100%. 1 minus B is the dividend payout ratio, correct? Now, first of all, we will calculation of earnings per share. How do we calculate that? EPS, right? So I'm just putting the numbers here. 30 lakhs net profit minus preference dividend 18 lakhs, 12 lakhs divided by number of shares 3 lakhs. 6 per share is the EPS, correct? Now, case 1, when dividend payout ratio is 25%. Then P0 is given by earnings, which is 6 rupees, 1 minus retention ratio, which will be 75%, divided by cost of equity is how much? Cost of equity is 16%, minus retention ratio is 75%. On that, the rate of return is 20%. Yes, Mancha, you are right. It is similar to P0 is equal to D1 by KE minus G that you studied in cost of capital. Very good. That is the right linking that we are doing. Okay. Somehow this IRR thing, I missed it. Actually, I am also not clear what is the question. So I will just go back and see in the study material, Mancha. Okay. Then I will come back. But my humble request to all of you, don't confuse IRR as of now. Okay. Hitesh, for 25%, 150. Very good, Hitesh. Very nice. Really impressed with all of you. You, Bharadwaj, your answer is correct. 150, 50, 37.5. Very nice. Okay, so if we put all these numbers, then it comes as 150. Now, coming to the second point, when DP is how much? Second case is 50%, correct? Then P0 is equal to 6, will remain 6. Your retention ratio, when your dividend payout ratio is 50%, your retention ratio will also be 50%. So this comes as 16% minus 50%, and on that 20%. So this comes as 50. And the third case, when DP ratio is how much? Is 100%. Then your B is 0, correct? So P0 is equal to 6, 1 minus 0%, divided by 16% minus 0%. On that you will earn 20%. So this comes as 37.50. So if you see, students, if you see in this case, the question said that R is greater than KE, 20% is greater than 16%, correct? Ultimately, your R is greater than KE, then your optimum dividend payout ratio should be 0. Now, if you see, as you're increasing your dividend payout ratio, your share price is falling. And hence, Gordon's model, in a way, is also taking the same argument into its computation, which is R is greater than KE, then your dividend payout ratio is 0, and hence your share price will be the maximum. Okay. I hope this is understood. Very nice. Hiral, your answer is right. Okay, students, now let us come to the next topic. Now, Gordon's model itself, there is one more thing which is called as, there is an extension to it actually, which is called as bird in hand theory. This is an extension of the Gordon's model. Okay. Now, what does it says? See, birds in hand theories means that dividend paid today will have a higher market price as compared to dividend expected 10 years from now, because shareholders want cash in hand today, right? This is what we have already discussed in our wealth maximization principle, right? While we were discussing the significance. Mansha is saying preference dividend is 12, not 18. Oh, sorry. Sorry, Mansha. This is 12 and this will be 18. Okay. Yes. So bird in hand theory is Gordon's model. So what they're saying is bird in hand means cash in hand. So if they're getting any dividend today, it will lead to a higher valuation compared to the expectation that the dividend will be paid in the 10 years from now. Okay. So what it says that investors prefer today's certainty over future uncertainty. I hope it is clear, right? Because in future it is uncertain, but today is certain. If you're getting it today, that means it is done and dusted. This amount you have realized, and hence the change that they have done to the formula is so the price. So again, this is given by Gordon only. So the price is equal to the dividend, which is paid last. Okay, so please remember P0 D0. That means the dividend is also paid in the current date. Okay, the price is as on today, the dividend is also as on today. In that you will multiply 1 plus growth. That means you will see that what is the dividend 1 year from now, because D0 1 plus growth means dividend from 1 year now, and divided by KE minus G. The same thing which Mansha has just now mentioned. Mansha has just now mentioned, which is P0 is equal to D1 by K minus G, KE minus G, right? So KE minus G you do to arrive at P0. The same thing, Mansha, right? You would have studied in your cost of capital the same formula, because this will give you D1 divided by KE minus G. Simple. Okay. So shall I write the notations here? P0 price as on today, D0 dividend current year, or sometimes it says that last paid dividend. Okay. G is equal to growth rate and K is equal to cost of equity. Okay. Then there is one more model. Okay, once this is done, so there we will be doing some questions on this. But before that, let me explain this one more model as well. Dividend discount model. Okay, now this model says that the price is equal to the present value of all the dividends expected in future. So the price is equal to, let's say dividend 1 is paid after the end of 1 year. So we will discount it like this. Then dividend 2 will be paid after the end of second year. So we will be discounting it like this. Dividend 3 will be paid at the end of the third year. So raised to the power 3 plus similarly plus D n means at the end of nth year raised to the power n. We will take a present value of all the future dividend payments expected. In this, there are three cases. One is zero growth. One is constant growth. And third one is variable growth. See, we are saying that dividend amount remains same. In the first case, we are saying that dividend amount remains same. There is no growth in the dividend. Okay. So whatever is the value, it remains same. So we can just use this simple formula. D divided by KE. This is for first case. Second case of constant growth. Okay, let us do this example first. Question number 5. Yes, Mancha, you are right. So Mancha has asked a very good question. What is the difference between Gordon and Gordon revised model? In both cases, we assume investor is risk averse as we consider expected dividend. That is right, Mancha. So that is what it is. In both the cases, we are considering the expected dividend. You're right. So the only difference is, see, in this particular case, if you go to this is the normal formula, right? So in this, you are saying that this is more from the company's decision making, how much they want to retain. Correct? And it does not take into account in the numerator. In the numerator, it does not take into account 1 plus growth factor. Correct? But in this case, so basically, see, I'll tell you, in this case, E1 will be an estimate from the company. Correct. But Gordon's revised formula, if you see the numerator, it changes to D0 and then it multiplies for the growth. So it is an investor facing formula is what I can say, right? Perfect. So, but the gist remains same, Mancha, because both revised and the normal one takes into account the dividend payment only. Okay. Now, illustration 5, X Limited is a no growth company. So growth is 0. Pays a dividend of 5 per share. If the cost of capital is 10%, compute the current market price of share, 50 rupees. Very nice, Hitesh. Okay. Question 5 is done. Now let's come back. Zero growth is very easy. Second is constant growth. So constant growth, since there is a constant growth in the formula, it will just be adjusted like this, which is actually the Gordon's revised formula. Okay. D0, 1 plus growth divided by KE minus growth. This is same. What we have just now studied in the Gordon's revised formula. So in the dividend discount model, for the constant growth, the formula is same. Now third one is variable growth. Now we don't know, in the first year the growth is 5%, second year the growth is 6%, third year the growth is 7%, fourth year the growth is again 2%. Correct. See, constant growth means that growth in all the years is same. Students, practically it never happens. Okay. In every year, growth is different. So hence variable growth, it says that whatever is the number coming, you take that. Simple. I mean, as we have mentioned this formula above, this is the formula for variable growth. So whatever is the dividend for that particular year, you take that as written above. That is the number for variable growth. Okay. Let us come to illustration number 6. XYZ is a company having share capital of 10 lakhs of rupees 10 each. Okay. 10 lakh are the number of shares. No. So 10 lakhs is the total share capital. It distributed current dividend of 20% per annum. There is a current dividend that is being distributed. Just a second, students. Let me see if there is any other query. Yes. So they have distributed 20% per annum current dividend. Annual growth rate in dividend is expected as 2%. G is 2%. The expected rate of return on equity, cost of equity is 15%. Calculate the price by applying Gordon's growth model. Okay. We know that P is equal to dividend, which is paid in current. We have to multiply it with the growth rate divided by K minus G. So P will be calculated as, what is the current dividend that we paid? 10 rupees, 20%, right? That is the dividend that we paid, multiplied by 1 plus 2%, whole divided by 15% minus 2%. So this is 2 rupees multiplied by 1 plus 2% divided by 13%. So price comes as 15.69 rupees. So Mansha is saying even 1 minus B is actually your dividend only. It is actually your dividend only. See, you will do what? Even 1 minus B is what? B is your retention ratio, right? So 1 minus B is your payout ratio, even into D1 divided by E1. This is get cancelled, right? So essentially this is nothing but your dividend only. Okay. Hitesh 15.69, Siddharth 15.69, and you Bharadwaj 15.69. Very good. The answer of all of you are very correct. Now let us come to the next question, number 7. Yes. A firm had paid a dividend of rupees 2 per share last year. The estimated growth of the dividends from the company is estimated to be 5% per annum. Growth is 5%. D0 is 2. Simple. Okay. Determine the estimated market price of the equity share if the estimated growth rate of the dividend rises to 8%, falls to 3%. So they are saying if growth is 8% or if growth is 3%, there are 3 scenarios they have given. Also find out the present market price of the share given that the required rate of return of the equity investor, which is KE, is equal to 15%. Okay. So the first of all, we will calculate the current market price per share. Okay. Then we will calculate the growth taking 8 and 3. First, we will use the growth rate of 5%. So using the Gordon's revised formula or the constant growth rate formula, we know that this is given by this. Correct? P0 is equal to D0, 1 plus growth divided by KE minus G. So P0 is equal to dividend of 2 rupees, right? Because they have paid a dividend of 2 multiplied by 1 plus growth is what? Growth is 5%. Then cost of equity is 15% minus 5%. So P0 comes as 21 rupees in the first case. Now coming to the second case, where growth is equal to 8%, we will just substitute everything in the formula, like 2 1 plus 8% divided by 15% minus 8%. So this comes as 30.86. Okay, if growth rate increases to 8%, then MPS, you have seen that it has increased from 21 to 30.86. Simple. Because if growth is increasing, then your current market price will also increase. And then if the growth rate is dropped to 3%, correct? Then 1 plus 3% divided by 15% minus 3%, which will give you a price of 17.7. In this case, the price has fallen. Yes, Siddharth, Bharadwaj, Hitesh, your answers are correct. 21, 30.86, 17.17. Hitesh, your answer is correct. Perfect. Okay. Now, there is a very, unique concept. So there is one more theory which is called as traditional theory. So it says that this is called as Graham and Dodd model. Okay, what is this is? This is not any scientific based. Okay, this simply says that price is equal to M D plus E by 3. This is some random formula that is given. Okay, P is equal to price per share. M is equal to some kind of a multiple, which will be given in the question. And actually speaking, this is not scientifically calculated. This is based on some of the conventions, or let's say some of the some of the estimations. Okay, D is equal to dividend and E is equal to earnings. So if you see this logically, what I can tell you is, yes, Khushi Kumari, Khushi Kankari, your answer is right. So logically, if you see, what I can tell you is that the price is more influenced by dividend compared to the earnings, because earnings is getting divided by 3 and dividend is not getting divided by 3. So more weightage is given to dividend. Hence, higher the dividend, higher the price as per this formula. Okay. We'll quickly do illustration 8 to understand this. So the earnings per share of the company is 30. Dividend payout ratio is 60%. That means dividend is 60% on 30, which is 18 rupees. Multiplier is 2. M is equal to 2. Determine the price per share as per the Graham and Dodd model. So the price is given by multiplier. Dividend plus earnings by 3. Multiplier is 2. Dividend is 18. Earnings is 30 divided by 3. 1028 into 2, which is 56 rupees. Simple. This is the price calculated as per that. Okay. Then comes the next question. The following information regarding the equity shares of M Limited is given as below. Market price is given, dividend per share is given, multiplier is given. They're asking you to compute the EPS using the Graham and Dodd model. So the market price is 58.33 is equal to 7 is the multiplier, dividend is 5 rupees, EPS is what we have to compute. This is the equation. Solving this, EPS will come as 10 rupees. Yes, you Bharadwaj, your answer is right. Shakti Vilan, answer is right. Hitesh, you're right. Hitesh, you're right. You Bharadwaj, 10 is right. Kushi is asking why divide by 3. See, that is just a random thing they are doing. They are saying that earnings will have a 1/3 weight compared to dividend. Simple. This is just a random number. Kushi, there is no logic. They could have done by 4 also, by 2 also, by 6 also, but they felt that, it is divided by 3. So earnings should have a 1/3 weight what dividend has as 1. Okay. Hitesh, your answer is right. EPS is 10. You Bharadwaj, your answer is right. Now coming to the next one more model. This is called as Linter's model. Okay, now again, this Linter's model is just, something he has also derived basis some of the convictions. I'm just writing the formula, and these are just formula based, discussions. That's all. Target payout minus DO into adjustment factor. Okay. Now it says that how much dividend it should be. It says that dividend in year 1 is D1, D0 is dividend in year 0. Actually, I'll tell you what Linters is doing. Yes, Hiral, you're right. But the question said that it is only 8% and 3%. Okay. Khushi, yes, EPS is 10, perfect. So see what Linter is doing. Linter is saying that you have to see a target payout ratio. Okay. Because it says that more than anything, your impact that comes to you is basis the differential of the dividend that is paid, not basis anything else, but basis the absolute differential that comes. So if you see, this is the absolute differential, right? EPS multiplied by target payout ratio. Target payout ratio you have to compute taking into mind, very long term period. Let's say 10 years, 20 years. What is your target payout ratio? So basis that, you will be arriving some kind of a expected dividend payout and minus the actual dividend that is paid. So this is the difference between expectation and the actual, and that you will multiply with some adjustment factor plus in D0, that will give you the D1, which is the dividend to be paid out after 1 year. EPS is earnings per share. AF is equal to adjustment factor. Okay, let us go to this question. So that's what, Siddharth, as I told you, target payout is something that the company has calculated, taking into mind future projections, future growth, future expectations, future policies, right? That how much in the long run they would want their average target payout ratio should be. Or it can be also understood from the shareholder perspective. Shareholder want this much target payout ratio, correct? It can be anything. Now, coming to question number 10. Yes. Given the last year's dividend is 9.8, speed of adjustment is 45%. This is the adjustment factor. Target payout ratio is 60% and EPS is 20 rupees. Compute the dividend using Linter's model. Simple. It's just that all the numbers are given. You have to fit it in this and calculate the answer. So D1 is equal to 10.79. Hitesh, your answer is right. Perfect. Okay. Now, see, there is one more simple thing which I will just put here, and then there is a term called stock splits. Okay. See, stock splits is what? There is a share with a 500 face value. Okay. There is one share. This is one share. So stock split will mean this will be splitted into 5 shares of 100 face value each. Right? This is 1, this is 2, this is 3, this is 4, and this is 5. So collectively, if you see, this does not impact any value, right? Because earlier there was one share of 500, now there are 5 shares of 100 each. There is no, any value is not impacted here. Now, why this is done? This is done by the corporates so that if earlier the shareholder was not able to sell one unit, he only wanted to sell part of that unit. Now that liquidity is increased with the shareholder, correct? Because now out of these 5, he can sell 2 and still hold 3. Correct? That is the only objective, to reduce the pricing. Pooja is saying these seem simple. Are these questions asked or we have to level up? I think, Pooja, see, from the understanding point of view, yes. But see, in the examination also, what they can do is, instead of asking, let's say in Linter's model, we are calculating dividend. So they might ask you the dividend of D0 instead of D1, right? Similarly, in the previous gram and dot model, they've asked you dividend, although the formula calculates price, right? So Mancha is asking, can we discuss some practical corporate cases? Recently, government approved Vodafone Idea deal. Okay, Mancha, we will see if the time permits, but that is not the current what I can say part of the curriculum. I mean, at least in this topic. Okay, these are case studies very interesting to know and understand. I definitely agree with you, and definitely appreciate the inquisitiveness that you all of you hold on these things. But because of the time limitations and to respect the time, we might or we might not have to do this. So the Siddharth is saying Tata Steels has recently done the stock splits. Okay, very nice, Siddharth. I am not aware. Maybe okay. So this is what the stock split is. Maybe this will be used somewhere in our next question. So this is what the dividend decisions is. Now we will cover a lot of practical questions like we have from question number I think 11 to 21 in our next session, and we will take some of the revision of what we have done both in risk analysis as well as in dividend decisions. Till that time, please revise well, please take your care, and please do take care of your parents, and please study well and yeah, revise the concepts well. Thank you. Thanks a lot for joining. Thank you. Technical team, session over.